Hey, I'm Tom Thornton with Hedge Fund Telemetry, and today we are doing our bi-monthly short interest data webinar with Jeff Garbaz with Quantitative Partners. Jeff, welcome.
Hey, thanks, Tom. Thanks for having me.
So here's our disclaimer. Please speed read. Okay, Erlanger Research, which I've used for 20 years, is really unique the way they look at stocks that have either high or low short interest, and they have other inputs that basically they have four types. And type one is a short squeeze. There's a lot of shorts involved here, and there's the potential for an upward move. Type two, yeah, there's decent amount of shorts involved, and the stocks continue to move higher.
Yeah, strong technicals are the biggest driver of that. And
yeah, the technicals.
Yep, and we want a short ratio that's got to be under 4 days. So
right. So type three, shorts are right, and because they're heavily shorting a particular stock, and the stocks are moving down. And then one of my favorites is the type four, the long squeeze. This is either the ones or fours are really the most important for me, because I like to see low short interest stocks that are vulnerable for moving down. And this is really a great place to find particular shorts. So Jeff, why don't you take it away?
Yeah, I'm going to start off with something a little different related to this. You got to give me, it says this will stop other screen sharing. Do you want to continue? So yes, Tom. So I think if I do that, then yours.
Yeah, take mine away.
Okay, great. Okay. So we're going to start with kind of a thing I do for clients. First of all, this is what happened last week. And here are the type ones. So stocks that are doing well technically and have high shorting. Here are the type twos, stocks that are doing well technically and have low shorting. Here are the type threes down here, weak technically with high levels of short selling. And here are the type fours, weak technically with low short selling. Why this is so important is because I've created a term, I call it the long short tsunami situation. And this is what destroys hedge funds, which is that either the ones go up, but the type threes go up a lot more, or the reverse of that occurs as well. So this last week, let's just take a look at the ones and look at Monday. They lost 1.23%. Oh, sorry, Tuesday they lost 1.23. We didn't have a market open on Monday. Then the next day they lost 2.2%. So through Wednesday they were down 3.43, and then they rallied strongly on Thursday and then Friday. So we finished the week with type ones up 26 basis points. And then if we look at over here, the type fours, let's say you were shorting type fours, the week reversed, the type fours are dropping really nicely. Then all of a sudden, boom, they reversed the last couple of days. They went from a minus 4.11 to a minus 3.04, and then all the way to a plus 1.55 on Friday. So if you were long short squeezes and short type fours, all of a sudden you're down 1.29% for the week. And that's what we call a long short tsunami. But what we do to track how the hedge funds are doing, we track everything that they're really involved with, the ones versus the threes. And you can see we just missed. So the short squeezes were up up 26 basis points, and the threes were up 1.23. So basically the week finished down minus 0.97. So we just slightly avoided being in a long short tsunami last week, but that may continue this week. And what's so interesting is there's one other little side effect that we look at. The type fours had a period where they lost money. So the shorts were making money if they were short type fours for 5 weeks in a row. And then we just finished a 4-week move that saw a slight gain during that period. It was a really great gain for the first 2 weeks. But there's definitely, we got to figure out whether we're in a market more now where people are going to be buying fours or people are going to be still selling fours, and it's still not completely decided. So that's why this is really key to watch and pay attention to. Tom, does that make sense?
Yeah. So why don't you tell us what happened in the last 2 weeks and when they calculated the short interest?
Yeah. So first of all, we just got the latest short interest data through the middle of February, and there was another nice addition to short interest. So that is going to cause more potential squeezes if the market can reverse and start to move higher. And so for that, we're going to switch over now to we're going to go into chart room and take a look at how we calculate that. And so let's go to Erlanger scans. And we're going to go down to sector data Erlanger. So here we go. Here is the average short rank. And what we do is we take how high or low the short selling is. Hang on, I'm going to go back up here for a second. I'm going to look at our, we took profits last week in our short squeeze screen, but these were our names from last week. So here's a great example looking at Valero. The way we get the short intensity is we look at the range of the short ratio historically. So you can see what's happened since June, July of last year. People have been adding to the short position, the gray area, and then the short ratio has been climbing as well. So that's how we calculate the short intensity. And then we look at all the stocks in each group in each sector to determine how high the short selling is on a group or on a sector level. So when we come back to the report that we were looking at before, we can see the highest short selling right now is in autos and components at 56%. Retailing's at 54.71. Food staples, retailing above, commercial services, real estate. So let's just take retailing as an example. If we come down to here and we go to sector group members, we can click on retailing, and then we can come in and see what names. These are names that are lightly shorted. Here are all the names that are heavily shorted. And so we can see as we scroll down, we look at a type. Joanne Stores is a type 1 short squeeze. We don't have a lot of, what you can see is because the technicals have been so poor, we have a lot more type 3s, ODP, but that does not determine our short selling on a sector basis, the short intensity level right now. So there's could be a big squeeze coming in the retail space. Tom, you want to jump in? Any comments on this, what I'm seeing so far?
Yeah, well, I think that I've seen the days that we see the short baskets going up. There's a lot of retailers in that group, so it doesn't surprise me at all. Why don't we talk a little about like the overall, like what you're seeing? Last time you were talking about semiconductors. Now we're looking at retailers. What else are you looking at? Where's
so
a
we
lot of shorts and where are a few shorts?
Yeah.
Where's
So
risk?
yep, exactly. So here are the names that were the biggest potential squeezes. Again, autos, retailing, food staples, commercial, real estate, and then where the lightest short selling now would be sub. It's interesting. Wow, almost everything's above 40 now. So banks, food, beverage, tobacco, and diversified financials. So to me, this is a place I'd really want to be looking at. Diversified financials for potential short ideas because it's ranked the 22nd sector. So here's how we do our sector ratings. We look at how high or low the short intensity is. We do a tech rank to it, and then an overall rank. So you can see that energy is at 47%, and the tech rank's at 74. So if we added those together, we would get 121. And it isn't an equal weighting between the two. The tech rank gets a little bit more. So that's why energy is number one right now. But our top sectors, energy, food staples, utilities, transports, material, consumer services. I've liked consumer services for a while. There's a lot of names that could really rebound there. Banks and real estate. And then here's kind of everything that to me still makes sense to be shorting until we prove that we've got that we're kind of done with this downside action for right now. So let's just go do what we did with retailing really quickly. Let's go back up here, go to sectors, members, and let's go look at diversified financials. Let's just take a look at what are the fours in there. There's a lot of them. And then let's subsort by the market cap. So here are the biggest names. So a key thing that Tom likes to talk about, and we talk about in these calls, is also how high or low the options rank is, which tells us whether there's excess put activity. So as an example, KKR and BK, let's take a look at BK right now. And let's go to, you can see that all of a sudden at this low, we kind of lost the put activity, and now it's come back again. One thing we do not want to do in this time period is to be shorting type 4s that have excess put activity, because that sets up for what we call a put squeeze. And you can see here right at the end of January, the options activity climbed, and then boom, we got a nice move to the upside in Bank of New York. Then the move was played out, the put activity disappeared, but now it's back again. So when we go and look at this list, as you look down it, and you're looking for ideas, one thing I like to look at are things that are in pullback mode, that don't have that like excess put activity. So FUTU would be a good example of something that if the market really fell apart, you can see it's been basing, but if it started to make the next leg down, it's pretty obvious it could go all the way to $25. So that's kind of a key thing that you want to pay attention to when you're shorting, is if you're near the end of a time period where the market's been really falling, you do not want to try and put shorts on and things that have a high option rank. And Tom, I know you can kind of back that up. You've had a lot of great examples over time on this.
Yeah, if you just go back to your main sentiment page, I just want to go and do a bit of a speed round. Let's look at Tesla, and these are some of the things that I look at. Really have been using the option rank, which is on the left side in the middle, where you see the green dots and the red dots. And this has been really, really helpful finding ideas on the long side and short side. So right now, Tesla, the way I would surmise is, if you look at that lower left panel, you see that there's been a fair amount of put activity. People have been buying puts on the way down. Makes sense because it's a $900 stock or $850 stock. And that caused a bit of a squeeze higher, similar to a short squeeze, but it's a put squeeze.
The last couple of days, an important component to it is, it isn't just that you got excess put activity. So let's take a look here and just make this a little bigger so everyone can see it. You need to get above this band here. This is called the DMA channel. And we're now basically almost in it. So the squeeze hasn't even really, I mean, it has started. Obviously, it hit $700 and bounced off of it. And then the put call 10-day is high, but we're just getting into the beginning of it. Whereas, like, let's look at BK the last time that occurred.
Well, hold on one sec, Jeff. Don't go anywhere. The one thing that I've been kind of noticing is that there's been a divergence, and it's actually on this one too. Or, well, right here, you can see you had it at 100% back in January. Now it's made a lower high on this this action here with the option rank. So I noticed that on a bunch of different stocks, that if you even look at SPY, let's just look at that, and you can see the option rank on that. So that made a lower high. I mean, you saw that there was a lot of call buying. You saw that briefly with the little 2 red dots at the recent high, and then things fell apart. People were buying puts, but it's not as heavy as normally, which that just jumped out. Qs as well, I think.
Yeah, you know what that says to me, and it's kind of interesting. I work with another individual who does a lot of what I call lattice work on the options market, and so you can see there was a lot of fear that came into the end of January. That's why we got this to 100%, and now there isn't quite as much fear. I mean, it's still decent. We're at like 85% now, but it's not at 100%, and we're at a lower low. And he's been seeing this in his work as well. And I know, like, Nomura does some of this gamma type work as well, and they're seeing it. So, like, basically, people aren't as hedged right now as they were at the end of January as it relates to SPY. So that could either be a good thing or a bad thing, because if we start breaking to a low again, and remember the low was on Thursday morning, we're only a couple days removed from that, and the fear just isn't as great. So actually, that's kind of an interesting point, Tom.
All right, so let's
Oh, we'll go to Qs. You wanted to look at the Qs.
Yeah, the Qs.
It's the same thing, same exact phenomena.
That was even more pronounced. That
Yeah.
it just didn't. you didn't get the amount of put buying that normally you would at that moment.
And Tom, just to kind of show you this, if we go look at this line right here is how many sectors have an option rank above 70. Because we have this on each stock, we can do sector work. And you can see here, we hit the absolute peak. And now we're only at 15 sectors. So same thing, we dropped very quickly after we got that little rally into February, and then it started climbing again, but we're not even close back to being above 20 out of 24 sectors, there.
Right. Hey, Jeff, we've looked at this before. Can you pull up the type fours, the percentage of type fours in the market? And then let's look at type ones, perhaps. So this is basically type fours are short squeeze candidates. Nobody's short. And then you have type ones that people are short.
Yeah, hang on. I got to figure out.
This is pretty cool.
Yeah, this is, oh, here we go. Okay, good. I went to the right place. I always kind of wonder about this sometimes because we have so many indicators sometimes. It's like, okay, where is this? Let's see.
There are so many indicators.
There's a lot of stuff here. If you want to do data
Yes.
testing type work, like our data has more indicators and stuff that you can test. So here you go. Here's where we are right now on the, I'm going to pull up the S&P because it's a little better than this, but there you go. 4%
Okay.
short squeezes and 6% long squeezes right now for the whole market.
So one of the things that we've done, and Jeff and I have looked at this a lot, is we look for spikes on the red line, which are the type fours, above 15%. When it gets above 15%, you're really vulnerable for some sort of pullback, and it's worked maybe a little better previous times. You see, one thing last year, we had very few and shallow pullbacks. We had 4% pullbacks, I think 3 or 4 times, and that's it. Now it's a little bit more pronounced. And now that 4% on the type ones, where does that typically go to get a real squeezy reading?
There's a squeeze. Back in 17, we got up to, I'll tell you what that number was. And you can see that was 8%. And you can see, look at this move that occurred in the S&P. It's a weekly chart too.
That was right. Oh no, that wasn't the election. No, that was 17.
That was 17. Yeah.
Okay.
Yeah. So kind of interesting to see that. We did get back.
Can you go further back?
There it is at the that period. That was obviously an 8, and that was a kind of a quickie. Remember, these are each bar is a month, so that was kind of a like a little rally before we then fell apart. And you can see by the time we started coming down, that had dropped off. But 2005 kind of got high. And here's a problem with looking at this data on a monthly basis, because it's where it is at the very end of the month. So if during the month it got a lot higher, it doesn't show in this data series.
Yeah, that makes sense.
A cool thing about our stuff is if you went back to daily, you could do this thing, Control Alt B, and I could change my number of daily bars to like 4,000 if I wanted to, and it would take me all the way back, and I could go all the way back in history. Our data goes back to the 80s, and we started doing the short interest stuff in 92, but you go all the way back to 92 and look on a daily basis and see where stuff got. But the monthly is not as good. Weekly, I think, is a better indication of kind of looking back. Oh, there's a nice high peak, and look at that. We got the type ones all the way up to 9%, and then look how that started a pretty amazing run.
Yeah, that's cool.
So
okay,
I told Tom when we were warming up too. This is kind of a key point, I think, for people, especially for anyone who's listening who runs a hedge fund. Your life is about to get a lot more difficult on the short side if the SEC's proposal goes through, where every month you're going to have to report your positions, and the world is going to see what you're short. That means that our data is going to become hugely valuable, because we're going to alert you to the earliest sign of a short squeeze starting in a stock. And it looks like they're pretty adamant about putting that in. So it's going to really increase disclosures for hedge funds. So
What about, hey, Jeff, what about like options activity? Will they have to disclose that as well? Have you heard?
right now they don't. And kind of a cool thing about that is I have two screens that I run, and this is our area where we have screens. They're kind of fun screens to do exactly what Tom said. We look daily at,
Oh, I love this.
I call this the Merlin screen. It looks at the call volume on like Friday as an example against the open interest. So Friday, Foot Locker, which I think got a downgrade this morning from someone, I saw a headline somewhere on that, traded 43,000 calls and the open interest was only 30,000. So that could be someone selling calls, and
That was they missed earnings and guided down, and it was just like a 30% drop. It was just a disaster for them.
Oh, was that today or was that
that was last week? Yeah.
Oh, okay, last week. So anyway, this could be someone short, but the point is this type of outlier is exactly what Merlin did to basically be short by selling calls. So you want to track the volume against the open interest. And so ZGNX is another name that was above 100%. And then we can reverse it and do the opposite. And this is what I call the Archegos screen, where I can look at and see, like, so Iron Net as an example, that could be someone buying it and selling puts, just like Archegos got caught on the Viacom example.
Foot Locker's on both of them.
Yeah, that would make sense, because on a day where there's incredible volume, but you can see that it's much more on the it was much more on the call side where the open interest was really high. This is only 58% against the open interest. So there's your number, there's your 10-day average, and then there's the put open interest.
Okay. Well, listen, Jeff, I wanted to make this brief. I think the summation of this is that shorts are involved again, and it's and then the put buying has been a little bit subdued versus the January period.
But it's still,
but I think
it's still at a higher level though. But
yeah, it's still high.
I'd say, like Tom, to your point, it was a 10 out of 10 at the end of January. Now it's like a 6.5 out of 10.
Right. The thing that I really have, why I look at the option ranks so much, is that this has been a market not necessarily of people that have shorted stocks. It's been all these new option players, and it really gives a faster read versus short interest, which comes out every 2 weeks. So when I look at the option rank, I know that there's the potential for a squeeze higher or lower, and it's been really, really valuable.
Awesome.
So let me see, we've got, yes, just let me let everyone know, we will be recording these and I will post it to our YouTube page, Hedge Fund Telemetry YouTube page. I'll get that done sometime today. Jeff, I'll be seeing you in 2 weeks, right?
You got it.
All right. No,
actually,
we talk every day though, so that's the funny
yeah,
part.
2 weeks
Anyway,
will be perfect, because now I get to go to Florida for like a national event the week of the 20th of March. So I get to go play some golf, which should be fun,
Sounds good. All right.
And watch my kids swim. What's a better thing than that,
Perfect. All right, gang, everyone, thanks so much.
Thanks again, Tom.
See ya.